Animal Spirits by George Akerlof and Robert J. Shiller. Animal Spirits by Akerlof and Shiller argues that conventional economics often overlooks the profound impact of human psychology on markets and economies. The book reintroduces Keynes's concept of animal spirits, emotions, intuitions, and narratives as the fundamental drivers behind phenomena like recessions, unemployment, and financial crises. By integrating these psychological factors into economic theory, it offers a more realistic framework for understanding economic fluctuations and crafting effective policy interventions that acknowledge human irrationality. Now, let's go through some pairs of questions and answers to understand the core ideas of the book. First, why do economic models often fail to predict market behavior? Because human psychology, termed animal spirits by Keynes, plays a crucial, often irrational role in economic decisions, driving phenomena like booms, busts, and unemployment beyond purely rational calculations. Traditional economic models often assume rational actors, but Akerlof and Shiller argue this overlooks fundamental human emotions and cognitive biases. For instance, collective confidence or fear can amplify economic trends, leading to self-fulfilling prophecies in financial markets or consumer spending. Understanding these animal spirits is vital for effective economic policymaking, especially during crises. Second, why is confidence so critical to economic stability? Confidence, or the lack thereof, drives consumer spending and business investment. When people trust the future, they spend and invest, fueling growth. When confidence wanes, economic activity contracts, leading to downturns. Confidence is more than just optimism. It's a belief in the stability of institutions, the fairness of markets, and the reliability of future income. For example, during a financial crisis, a sudden loss of confidence can cause a credit crunch as banks stop lending and consumers hoard cash, exacerbating the crisis. Governments often try to restore confidence through clear communication and decisive action. Third, why does a sense of fairness matter in economic outcomes? Perceptions of fairness influence people's willingness to work, save, and participate in the economy. Perceived injustice can lead to resentment, reduced effort, and calls for redistribution or regulation, impacting market efficiency. People aren't purely self-interested. They care about how resources are distributed and whether processes are just. For instance, if workers feel their wages are unfairly low compared to executive pay, it can reduce productivity and increase labor disputes. This animal spirit explains why public support for certain policies, like progressive taxation or social safety nets, often hinges on perceived equity. Fourth, why is corruption or bad faith so damaging to an economy? A perception of corruption or dishonesty erodes trust, discourages investment, and distorts market signals. It diverts resources, creates uncertainty, and ultimately undermines the foundation of a healthy, functioning economy. When businesses and individuals believe that rules are not enforced fairly or that outcomes are determined by illicit means, they are less likely to invest, innovate, or engage in long-term planning. This animal spirit explains why developing economies often struggle with attracting foreign investment despite potential opportunities. The lack of trust makes contracts unreliable and risks unmanageable, inhibiting growth. Fifth, why does money illusion persist despite economic education? Money illusion refers to our tendency to think in nominal rather than real terms, ignoring inflation. This often leads people to feel wealthier with a nominal pay raise, even if their purchasing power hasn't increased, influencing spending and wage demands. This animal spirit shows that people don't always fully account for inflation when making economic decisions. For example, a worker might be happier with a 3% nominal wage increase when inflation is 4%, compared to a 1% nominal increase when inflation is 0%. This can have real effects on wage negotiations, consumption patterns, and even investment choices, contributing to economic inefficiencies if not understood by policymakers. Sixth, why are stories and narratives so powerful in shaping economic behavior? Humans are storytellers, and compelling narratives about the economy, technology, or financial markets can drive collective behavior, creating booms, busts, and influencing policy preferences more than pure data. Economic decisions are often based on shared narratives rather than purely rational calculations. For example, the dot-com bubble was fueled by a powerful story of a new economy driven by internet technology, leading to irrational exuberance and overinvestment. Similarly, narratives about austerity or stimulus can sway public opinion and political action, demonstrating the profound impact of collective storytelling on economic outcomes.
Seventh, why does unemployment often persist even when jobs are available? Unemployment isn't just about a lack of jobs. It's heavily influenced by the animal spirits of employers and workers, including confidence, fairness, and the stories they believe about the economy's future, leading to sticky wages and reluctant hiring. Employers' confidence in future demand dictates their willingness to hire, even if current labor is cheap. Workers' perceptions of fair wages prevent them from accepting lower pay, creating a mismatch. Akerlof and Shiller argue that fear of economic downturns can make businesses hoard cash and delay investment, contributing to persistent unemployment even in periods of recovery, defying simple supply and demand logic.
Eighth, why do recessions and depressions occur and persist? These downturns are driven not just by economic shocks, but by a sudden collapse of animal spirits, especially confidence, leading to a vicious cycle of reduced spending, investment, and employment, which rational models struggle to explain fully. A loss of confidence can cause a ripple effect. Consumers cut spending, businesses halt investment and lay off workers, which further reduces demand and amplifies the initial shock. This self-reinforcing dynamic, fueled by fear and uncertainty, can trap an economy in a prolonged downturn. Traditional models often miss this psychological feedback loop, failing to account for the depth and persistence of such crises. Ninth, why do people save or spend more than predicted? Savings behavior is influenced by animal spirits like confidence in the future, fear of economic insecurity, and the stories people tell themselves about their financial stability, often overriding purely rational calculations of interest rates. People might save excessively during uncertain times, even if interest rates are low, out of fear of future job loss or medical expenses. Conversely, during periods of high confidence and speculative bubbles, they might spend and invest recklessly. This paradox of thrift, where increased saving by individuals can collectively harm the economy, is a prime example of how animal spirits can lead to suboptimal macroeconomic outcomes. 10th, why do housing markets experience irrational bubbles? Housing bubbles are fueled by animal spirits like speculative confidence, the narrative of ever-increasing property values, and the money illusion that people feel wealthier as their home's nominal value rises, leading to unsustainable price increases. During a housing bubble, buyers believe prices will continue to rise indefinitely, encouraging them to take on excessive debt. This collective belief, often reinforced by media narratives and peer behavior, creates a self-fulfilling prophecy until the bubble inevitably bursts. The feeling of wealth from rising home equity, even if it's just nominal, encourages further consumption and investment, exacerbating the bubble. 11th, why is the stock market so volatile? Stock market volatility is largely driven by animal spirits, such as investor confidence, fear, and the compelling narratives that circulate about particular stocks or the overall economy, leading to rapid shifts in sentiment and prices beyond fundamental value. Investors often react to news and rumors with a herd mentality, amplifying price movements. A sudden loss of confidence can trigger a sell-off, even if underlying company fundamentals haven't changed. This psychological aspect explains phenomena like market crashes and irrational exuberance, where prices detach from intrinsic value due to collective emotional responses and shared stories about future prospects. 12th, why do governments need to intervene in the economy? Governments must intervene because animal spirits can lead to market failures, recessions, and persistent unemployment. Active fiscal and monetary policies are often necessary to restore confidence, stabilize markets, and counteract negative psychological feedback loops. Left unchecked, negative animal spirits can plunge an economy into a deep and prolonged crisis, as seen in the Great Depression. Akerlof and Shiller argue that government intervention, through measures like stimulus packages or interest rate adjustments, isn't just about managing aggregate demand, but also about managing collective psychology. These actions aim to restore confidence and break the cycle of fear, encouraging spending and investment. 13th, why does inflation or deflation sometimes become entrenched? The animal spirits of money illusion and shared narratives about future price changes can make inflation or deflation self-fulfilling. If everyone expects prices to rise, they demand higher wages, leading to actual price increases, and vice versa. Expectations about inflation are a powerful animal spirit. If workers expect high inflation, they demand higher wages, and businesses raise prices in anticipation. This creates a wage-price spiral, embedding inflation into the economy. Conversely, in a deflationary environment, people delay purchases, expecting lower prices, reducing demand and reinforcing deflation. Central banks must manage these expectations to maintain price stability. 14th, why do debt cycles occur and amplify economic swings? Debt accumulation and deleveraging are heavily influenced by animal spirits, like excessive confidence during booms, leading to reckless borrowing, and fear during busts, prompting rapid debt repayment that further contracts the economy. During periods of high confidence, individuals and businesses take on more debt, believing future income will cover repayments. This fuels economic expansion, but creates fragility. When confidence collapses, fear drives a rapid deleveraging, where everyone tries to pay down debt simultaneously. This collective rush to repay reduces demand and investment, exacerbating downturns, a process that rational models often underplay. 15th, why is trust in institutions so vital for economic functioning? Trust in banks, regulatory bodies, and legal systems is a fundamental animal spirit. A breakdown of this trust can trigger financial panics, capital flight, and a paralysis of economic activity, far exceeding the impact of any specific policy. If people lose faith in banks, they withdraw their money, causing bank runs. If they distrust government regulators, they might engage in illicit activities or avoid legitimate markets. The animal spirit of trust ensures that contracts are honored, investments are protected, and transactions occur smoothly. Without it, the entire economic fabric unravels, demonstrating its crucial, often underestimated role. 16th, why do self-fulfilling prophecies play a role in economics? If enough people believe something will happen in the economy, like a bank run or a market crash, their collective actions can make it a reality, even if the initial belief was unfounded. This is a powerful manifestation of animal spirits. For example, if rumors spread that a bank is in trouble, even if it's solvent, depositors might rush to withdraw their money out of fear. This collective action can deplete the bank's reserves, forcing it to fail. Similarly, if investors widely believe a stock's price will fall, they sell, causing the price to drop. These prophecies demonstrate how shared narratives and confidence can override fundamental economic conditions. 17th, why is there a psychological component to the multiplier effect? The multiplier effect, where an initial spending injection leads to larger economic growth, is amplified or dampened by animal spirits. Confidence encourages further spending, while fear causes people to save, reducing the multiplier's impact. When a government invests in infrastructure, the direct spending is only part of the story. If this investment boosts public and business confidence, animal spirits, people are more likely to spend and invest their newly earned income, leading to subsequent rounds of economic activity. Conversely, if confidence is low, people might save the new income, reducing the multiplier's effectiveness and limiting economic recovery. 18th, why does moral hazard become problematic in financial crises? Moral hazard, where individuals take more risks because they are protected from the consequences, is exacerbated by animal spirits. The belief in bailouts or lack of accountability can lead to reckless behavior that destabilizes the entire system. If financial institutions believe they are too big to fail, the animal spirit of overconfidence can lead them to take excessive risks, knowing that the government will likely step in to prevent a collapse. This creates a cycle where reckless behavior is implicitly encouraged, making the financial system more fragile. Akerlof and Shiller highlight how this perception of safety distorts market incentives and contributes to systemic risk. 19th, why are speculative bubbles a recurring feature of markets? Speculative bubbles are primarily driven by the animal spirits of overconfidence, herd mentality, and compelling narratives of quick riches, leading asset prices to detach from their fundamental value until the collective belief collapses. During a bubble, investors buy assets not for their intrinsic value, but because they expect prices to rise further, driven by the belief that others will also buy at higher prices. This greater fool theory is a powerful psychological phenomenon. The narrative of a new era or can't-miss opportunity fuels this irrational exuberance, which is often reinforced by media and peer pressure until the bubble bursts, causing widespread losses. 20th, why are traditional economic models often insufficient? Traditional models, largely based on rational choice, often fail because they overlook the powerful and sometimes irrational influence of animal spirits, emotions, narratives, and social psychology on real-world economic decisions and outcomes. By assuming individuals always act rationally to maximize utility, conventional economics struggles to explain phenomena like persistent unemployment, speculative bubbles, or the depth of recessions. Akerlof and Shiller argue that incorporating animal spirits provides a more complete and realistic understanding of how economies actually function. This expanded framework is crucial for developing policies that effectively address human behavior.
That's all for today's book. How do you think? Do you have any feedback or your own ideas popping up in your mind? Please feel free to let us know by leaving a comment in the comment section below. Also, don't forget to subscribe to get updates on new book summaries from us. Thanks and have a good day.